Well, hello, I'm Stephen Kirby. I'm the presenter of this webinar, also author of You Are the Change. It's a beginner's guide to social responsible investing. Hey guys, if you have any passion towards the environment, gender equality, animal welfare, animal rights, whatever it may be, grab a copy of the book. It's on Amazon or Kindle. We make no money from it. All profits go to local charities. Again, we're not looking to make money on the book, but it's a message that's important. We have a tremendous opportunity right now to make a difference by demanding accountability from the companies that we invest in. If you invest in a company, you're an owner of that company. We can hold them accountable. Again, we all need to invest just to ensure our own personal financial safety. So why not invest to make an impact as well? That's what the book is about. Again, it's called You Are the Change. It's a beginner's guide to social responsible investing. Grab it on Amazon or Kindle. Again, my name's Stephen Kirby. I'm the author of the book. I'm a public speaker. I am also a financial advisor. I am the first chartered social responsible investing consultant in the entire country through the College of Financial Planning. I've been doing this for a while. This topic is one that I'm extremely passionate about, and it's important for a number of different reasons. First off, we know that there's a $30 trillion wealth transfer happening over the next 3 to 4 decades, and women are poised to inherit a good portion of that. The issue with that is we know that statistically about 15 to 20% of women are in my financial planning industry or in the financial planning industry, so there's a lack there of women helping women, okay? And the concern with that is we know that, again, statistically, we're looking at about maybe 22 to 23% of women have actually created a financial plan to make sure that what they're doing today is going to pay off in the future. So I want to try to help that any way I can. Before we get going, one last housekeeping item. Please grab a pencil, pen, paper, whatever you may have. Write down this phone number, 515-729-4486. Again, 515-729-4486. That's my personal cell phone number, my business number. Call me. This is a recorded webinar, okay? I'm a rookie here. I didn't want to take any chances and go too crazy and be live, so I've recorded this webinar, so I'm not going to be able to answer your questions throughout the presentation, but it's going to be a fast presentation, and I'm hoping folks will follow up with a phone call afterwards so they could ask questions that they may have, look for guidance. If I could help in any way, shape, or form, I want to be able to provide that as well. So again, 515-729-4486. Guys, let's get this thing going, okay? The format here is we're going to talk about retirement savings challenges for women, and then some strategies, obviously, to overcome them. Women face some unique challenges. Some of the roadblocks that they face are similar to similar roadblocks that we all face, but again, because of the unique challenges, they'll have a different path to navigate those. But let's get into it. Again, unfortunately, I can't stop and answer questions, so write them down. When the presentation is over, feel free to give me a call, and I'll help in any way I can. Okay, so when it comes to saving for retirement planning for retirement income, women face a number of unique challenges. Again, we're going to discuss these in a little bit more detail, but the overflow here, the overview is obviously longer life expectancies, which means you're going to have to plan for more years in retirement. What we also see is because of their longer life expectancies, women should also consider that they may spend some of their retirement years living on their own. We also find that women are likely to take career breaks for family caregiving. Now, this has changed significantly over the last couple decades, but still women are the primary family caregiver for children and elderly parents, okay? And because women often earn less, have less retirement savings, and lower Social Security benefits. So again, lower wages have an impact that's a trickle down on retirement savings and Social Security benefit. So it's important to recognize these challenges and plan accordingly. Again, the game here, guys, is plan. Let me hit you with something that just some reality. There is no second chance here. There are no mulligans. There's no do-overs. Where you are today is where you're at. There's no changing that, okay? It's where we're trying to go. So my emphasis is always on planning. Where are we today? Where are we trying to go? And what do we need to get there? And then what roadblocks along that path are going to try to prevent us that we need to navigate? It's pretty simple though, but we need to know where we are today and where we are going, guys. We need to know. So planning is crucial. Most of us go to work, so at some stage in the future, we have financial independence. Financial independence is that stage in our lives where we have enough assets working for us where work is optional. Okay, I don't like the word retirement. Many of us will continue to do things that we're passionate about, but that's the goal. So you go to work to do this, but most folks, if you ask them, can you name me 3 investments in your retirement program at work? They can't. When was the last time that you rested your future welfare, your family's future welfare, on investments or ideas or concepts that you don't understand? The problem is that's what we're doing nowadays. So I want to help with that. So again, understanding that women are going to face some unique challenges. This all goes back to planning. So understanding these challenges and how to put them into your plan accordingly, okay? So statistically speaking, and all other things being equal, you're likely as women to live longer than men your age. It's that in itself is not a bad thing. You just need to plan for more years in retirement. We know at age 65, a woman can expect to live on average about 20.6 years compared to 18 years for a man. The bottom line is don't underestimate the number of years you may spend in retirement. We'll talk about it a little bit in the future here. To me, I actually recommend that men and women consider a retirement of 25 or 30 years. Again, with modern medicine and longevity increasing, something to consider, okay? Now again, women have a higher likelihood of living on their own in retirement. According to recent statistics, older women are much less likely to be married than older men. 46% of women are married compared to 70% of men, which is interesting. What I also found interesting is almost half, 44% of all women age 75 or older, 44% of women, all women age 75 or older live alone. Okay, so for married women, the loss of a spouse could also mean a reduction in retirement income from Social Security and or pensions. But the point being is a good portion of women, almost half, age 75 and older, will likely statistically be living on their own. Okay. Another issue, another challenge is women are more likely to take career breaks for caregiving. Again, this has a trickle-down effect. Okay, sometimes this is by choice, but moving in and out of the workforce has several significant financial implications for women. All right, first off is the loss of income and employer benefits such as retirement benefits and health insurance. Now, obviously, lost income means potentially lower savings. That's pretty simplest. And also potentially lower Social Security retirement benefits. This is because your benefit is based on the number of years you've worked and the amount you've earned. Okay, so it also leaves them vulnerable to economic vulnerability in the event of a divorce or a spouse's job loss, and possibly they may find it more difficult to find a job or comparable jobs in terms of pay and benefits when re-entering the workforce. All right. So again, the thought that women just walk back in with the same pay, same job isn't accurate. All right. So even women that do remain in the workforce, though, are much more likely to request flexible work schedules to meet primary caregiving responsibilities, which can obviously impact their salaries and their long-term career advancement. So again, this is something that for years I don't think people have taken into consideration. It does have a major impact, again, as we can see here, and a lot of trickle-down effects. We also know that challenges women generally earn less, and again, just based on the other challenges that we've talked about, we can see that this is going to have a trickle-down effect. So again, according to the Bureau of Labor Statistics, women who work full-time earn on average about 82% of what men earn. Now, this wage gap obviously is going to impact your overall savings, as we've discussed on some of these other slides, in the form of Social Security, retirement savings, retirement benefits, and potentially pension. Okay, it also means, again, that women are more vulnerable to unexpected economic obstacles such as a job loss, single parenthood, illness, or the loss of a spouse. So again, these are some challenges that folks aren't taking into consideration, but we need to as we're looking at this financial plan. Again, the objective here again is planning. So where are we today? What are we trying to do? What are some of these challenges that we're going to face? As a starting point, as we move into the planning process now, so we've talked about some of the challenges that women are going to face. We're going to talk about some of these, what I call roadblocks, taxes, inflation, healthcare costs, etc., that you're also going to face. But that's why it's important again to get into the planning process. So as a foundation for the planning process, as I mentioned a couple times, is where are we today and what are we going to need? So let's talk about how do you calculate the annual income you're going to need in the future, and some rules and thoughts on that. So what we hear, and I don't like, but what we hear quite a bit from folks that are coming in is these general guidelines. Okay, it's often stated that you should plan on needing about 60-90% of your pre-retirement income. The appeal is this is a simple approach. So I understand it's simple math, it's easy to do, but the general guidelines like this to me just aren't super helpful because they don't take into consideration your individual circumstances, your expectations, your goals, your time frame, these types of other assumptions that we need to take into consideration. I think it's fine to use a percentage of your current income as a benchmark, But what I find is more important is to focus on your current expenses, to really think about how those expenses are going to change over time as you transition into retirement. For example, expenses like a mortgage, the cost of commuting to and from work, these may disappear during retirement. Other expenses may increase, like yard care services, snow removal, home maintenance, travel, etc., etc. So just take these things into consideration. And again, and if you'll be using your newfound free time in retirement to travel more, again, take up new hobbies, you'll need to factor these in as well. So again, just try stopping for a minute, creating a visualization of what your future looks like, so you can create that into your plan just as common sense, and so you can list your expenses and project your future spending. So again, you can get really dorked up into this. To me, it's really looking at what your expenses are today, what you expect them to be into the future, so then you're able to create an idea or a guideline or an outline of what you need from an income standpoint. We need to know what we're trying to achieve. And then it's easy to test that math. Where are we today? What are we saving on a month-to-month, annual basis, based on a reasonable rate of return? Will it get us to that goal? So we need to know that today. And I always tell folks, when it comes to financial planning, it's almost like folks going to the doctor. It's like they don't want to go to the doctor for fear of getting this diagnosis of something bad. We need to know what the diagnosis is so we can write the proper prescription. Not knowing that you're going to run out of money or not knowing that your retirement plan isn't going to work is not helpful. Knowing it today, now you can make some adjustments. So it's important, again, go get the diagnosis so we know how to write the right prescription for you. Okay? So we created this income goal. We need $75,000 a year to live. Let's say $50,000 so we can move with the accounting for inflation slide. So let's say you need $50,000 a year to survive. Great. We know that inflation we're estimating at about 3%. So that means in 25 years, you're going to need to find a way to double your income in retirement. So again, if you're planning on living off $50,000 today, in 25 years, that $50,000, you'll need $100,000 or more to have that same buying power. So many folks are going to have to find a way to double and triple their income to get into retirement. People aren't taking this into consideration. It is the silent killer. I've got clients that have paid more, that are in retirement now, that paid more for their last car than their first home. So take that into consideration. As you're doing this analysis, understand, what is gas going to cost in the future? What is a home going to cost? What are groceries going to cost? And again, if you use 3%, we're going to want to find a way to double or triple your income in those time frames. Another impact that folks, like inflation, that's often overlooked, is the aspect of retirement income planning is taxes. Taxes can eat into your income and significantly reduce the amount you have available to spend in retirement. So you're just going to want to make sure that you understand whether the income you're counting on is or is not subject to tax. So for example, private pensions are generally fully taxable. Okay. You also might be surprised to learn that a portion of your Social Security retirement benefits may also be taxable, depending on your filing status and your total annual income. Okay. So just keep in mind that some income, like interest, is taxed at ordinary income tax rates. Okay, and other income like long-term capital gains, qualifying dividends, currently benefit from a special, generally lower maximum tax rate. So there's ways to take advantage of that. Okay, and then there's some specific investments like certain municipal bonds that can generate income that's going to be exempt from federal income tax and sometimes state tax as well. So we're trying to create income in retirement. There's some ways to do that in a tax-efficient way. And also, guys, you just have to understand how distributions from your tax advantage accounts, like your traditional IRAs, your 401ks, 403bs, 457s, essentially, these are generally these distributions from these accounts are taxed as ordinary income. So when you retire, you pull money out of these, they're taxed as ordinary income, regardless of whether investments from these accounts have generated long-term capital gains or qualified dividends. It's irrelevant. So basically, put in $1, it grows to 1,000. You pull that 1,000 out, it's going to be taxed, okay, as ordinary income. Now, special rules do apply to items such as Roth IRAs, Roth 401ks, Roth 403bs, Roth 457s, Roths in general, which qualified distributions from these accounts, which are funded with after-tax dollars, are free from federal income tax. The next presentation my partner and I are going to do is going to be on Roths. This is a crucial piece. If you're working with an advisor, if you're not working with an advisor, if you haven't considered a Roth for your personal situation, please consider it. Talk to a tax advisor about it, or again, give me a call after this webinar and I will help you with that or give you some information on that. But it's something that I think folks should at least consider, okay? But taxes are crucial as I go through retirement planning with folks. It's not what you make necessarily, it's what you keep. So understanding that when you hit retirement that you may have different buckets of money that are taxed differently, and how you pull those different pieces of income or how you pull income from these different buckets are going to dictate your taxable income in retirement. So you could have some play with that if done properly, okay? Now, if you've sat down with a financial advisor and you've talked about retirement and healthcare costs have not come up, flee, okay? It is the number one conversation we need to have with our clients as it relates to retirement, because it's usually what we find is their number one concern. Okay, so when you're calculating how much retirement income you need, again, one of the most important expenses you need to consider is healthcare. Not only does a longer life, okay, expect to see more retirement years to plan for, it also means you're likely going to spend more on healthcare premiums and uninsured expenses, okay? So for a married couple, there's also this risk that savings are going to be depleted by healthcare costs relating to the passing of the first spouse, which we see this quite a bit, which can reduce the amount available to surviving spouse. So the first spouse is sick for some period of time, it depletes savings, then they pass on, leaving the surviving spouse in just not as good as position as they were previously. And again, in addition to general healthcare premiums and expenses, many women will have a need for long-term care. So this is something we'll have another conversation about as well, or again, you could feel free to call me on it, because you're likely to be living on your own in later years. So long-term care refers to the ongoing services or support needed by people suffering from either chronic health conditions or disabilities. Again, long-term care in the past was a more traditional investment product, so to speak, like term insurance almost, and they had variables of it. Now there's some more hybrid policies out there, but the point is, it's a good probability that you'll need long-term care in retirement. 57% of women over age 65 will need some sort of form of long-term care, and we know that the average cost of a nursing home right now is almost $7,000 a year. So again, planning on healthcare costs in retirement is crucial. If you have not done it, please consider doing it. Reach out. It's going to make a difference in your plan, okay? So, how long will your retirement last? So we flirted with this earlier when we talked about longevity, but let's get into it, because again, from a financial planning standpoint, I like to overpromise or underpromise, overdeliver, so to speak. I don't want to plan on clients living 15 or 20 years. I'd rather than plan on 25 or 30 years so they don't outlive their money. I think that's a crucial piece of it. So if you're doing a plan for yourself, it's something to consider. So now that we've talked about how much annual income you're going to need, again, let's discuss how long that retirement income needs to last. All right. Well, the good news is we're living longer. Now, the bad news is that generally means your retirement income is going to need to last for a longer period of time. Okay. As I mentioned earlier, the average 65-year-old woman today can expect to live for another 20 years or so. And life expectancy has increased at a steady pace over the years, and it's likely can continue to increase. So it's not unreasonable to plan for retirement, as I've mentioned a couple times, to last 25 years or more. I think this is crucial. This is what I recommend to clients to do. Again, I've not had clients retire with too much money and they're upset at me because they save too much. I'd rather you be prepared. So just consider that this is a more conservative strategy as far as planning for more retirement. So then the question will be, where is this retirement income coming from? I'm sure you folks have heard of the old three-legged stool concept, which includes Social Security, employer pension, and individual savings and investments. I mean, the first two legs of the stool, Social Security, employer pension benefits, essentially produce a steady or relatively fixed stream of income that you can depend on during retirement. And then what we try to do is use the individual savings or investments to fill in that gap to provide the income that you need. The concern is a lot of companies have done away with the employer pension, so you do have some states, municipals, etc., that still do have these pensions. Understanding this pension, which we're going to talk about in a couple slides here, and how to maximize that pension is crucial. I could have 4 presentations just on pension maximization, and we'll give a quick hint on that as we move forward. Okay. But let's just do some quick Social Security basics. I know a lot of folks are more educated on Social Security, but let's just go through a quick basic rundown on about 93 or 94% of U.S. workers are covered by Social Security. And Social Security is a major source of guaranteed lifetime retirement income for most Americans. My concern, though, is for some women, Social Security makes up most, if not all, of the income they're going to have in later years. So how do you qualify? Well, to qualify for Social Security benefits, you generally need to work about 40 credits, or need to earn 40 credits, which is 10 years of work, basically a credit per quarter, or you can qualify for spousal benefits based on your spouse's work record up to a maximum spousal benefit of 50%. So again, something to take into consideration. A lot of folks ask, well, I haven't gotten a Social Security statement in a while. My understanding is they're not mailing them out as often, if at all, but you can go online and find your statement, and I'm going to recommend you do that as you get into the planning process. Now, the amount that you're going to receive from Social Security is obviously based on a number of years you've worked and the amount that you've earned. So your benefit is going to be calculated using a formula that takes into account your 35 highest earning years, all right? So if you've had some years where you've earned little or nothing during some of those years, it may be to your advantage to work maybe longer, to work long as possible, because then you have the opportunity to replace a year of lower earnings with a year of higher earnings, which could potentially result in a higher retirement benefit amount, okay? So something to take into consideration. Another plus is Social Security annual cost of living increases. So you get what we call a COLA, cost of living adjustment on Social Security is anywhere between 2 and 3%. But this is based on your original base, your benefit base. So the higher your benefit base, obviously the higher that cost of living adjustment amount is going to be for you here. And then the age in which you start claiming benefits is also going to affect the amount you receive. We get it all the time. When should we start? When should I start collecting my Social Security benefits? And again, there's no perfect answer. I'll give you a couple general answers, and again, call for specifics because everybody's personal situation is different. But at age 62, that's the earliest you could receive your benefits. You're going to take about a 25 or 30% reduction in your benefit. Full retirement age, depending on your birthday, could be age 66 or 67. That's when you receive your full benefit. That's the ideal scenario, or a good scenario, so to speak. Then age 70, obviously, they're going to give you a premium or a benefit increase of about 32% for waiting. So when does it make sense for you? Again, everybody's situation is different, but what I find is what I tell folks, if you don't need it, maybe you don't take it. If you don't need it and you're taking it, there could be some tax ramifications to that. There could be some other issues with it. Or again, if you're a married couple and if you don't need it, understanding that maybe in the future some income may go away when one spouse dies, it may make sense to put that one Social Security benefit on ice to receive a larger benefit in the future. So there's a lot of really good and clever strategies that you could use with Social Security to maximize your benefits. It's something you need to understand and take seriously. And again, call with any questions on it. But again, the bottom line is that at age 62, if you took it in this example, we could see the drastic difference in benefits between age 62 and 70. Again, in this scenario, a little over $1,000 a month. So again, there's no right or wrong answer. It's an individual decision that's going to be based on many, many, many factors, such as other source of retirement income, your life expectancy, marital status, whether you're going to continue to work after taking benefits, your tax picture, etc. The bottom line, though, is that for most women, Social Security alone isn't going to be able to provide you enough retirement income. So what do? There's the bottom line. Okay? Let's talk about employer pensions. I don't want to spend too much time on this. This is a whole presentation. If you do have a pension, pay attention. Give me a call afterwards because there's a lot more to this. If you don't have a pension, sit tight. I'll get through this pretty quickly. But we're seeing fewer and fewer Americans are covered by such plans. It's just the way of the world. But they can be complicated, all right? And it's important to understand how they work. A typical pension benefit is payable monthly over the plan's participant lifetime, okay? Starting at normal retirement age, let's just say for this example, age 65. This is what we call the single life annuity. However, once the plan participant dies, benefit payments end, okay, even if a single payment hasn't been made. So option one is a single life annuity you can see on the screen. That means that option one, you get it, you pass on, it goes away. Simple as that. You'll receive it for your life, but when you pass on, it goes away. The other option, again, if you're married, federal law actually requires that the benefit be paid as a qualified joint and survivor annuity unless both you and your spouse agree to receive the benefit as a single life annuity or in other form. So again, to protect spouses, the government federal law has created this where your spouse can't just say, I'm taking single life annuity, the heck with you, unless you agree to that. Okay, so currently the Qualified Joint Survivor Annuity, the QJSA, pays a monthly benefit to the plan participant and then continues to pay either 50 to 80, anywhere from 50 to 100% of the amount to the surviving spouse after the plan participant dies. And we're going to get into that. So that means, and again, option one, single life annuity, they're collecting it, they pass on, the pension goes away. Under the Qualified Joint Survivor Annuity, once the first spouse dies, the other one will continue to collect that benefit. All right. Let's talk about some of these benefit options. And again, as I mentioned, obviously one of the most important retirement decisions. I can't stress that enough. Let me give you guys just a quick example. Again, I don't want to spend too much time on this because it's a whole nother presentation. And if you have questions, I can't recommend that you call me enough. Okay, here's an example. So in this case, the participant would receive $4,000 a month. That's the single life annuities we discussed on the previous slide. If they pass on, the surviving spouse and the beneficiaries, kids, children, if any are involved, would get zero. Let's just hop down to this option. This is probably the most popular option, would be the 100%, which means they're taking a reduction of their benefits. So instead of $4,000, they're taking $3,600 a month, which is a $400 a month reduction. But if they pass on, the surviving spouse will also receive $3,600 a month for their lifetime. So you can see the appeal to this. They're taking a small reduction to provide a death benefit. Notice how I use that word, death benefit. Okay, because that is essentially what it is, something that we recommend folks at least consider looking into, depending on, again, where you are in your retirement process. Is what we see here is this is a $400 a month difference. So you're giving up a $400 a month difference to buy a death benefit. So the question, what is this benefit to the surviving spouse? This $3,600 a month, is it $500,000 over their lifetime? I don't know, but let's just say hypothetically, it's $500,000 you would need to provide this benefit to the surviving spouse. Then the question is, can you buy permanent life insurance for $400 a month to cover that? Because here's the concern, unless you have what we call a pop-up pension, if you take this selection versus this selection, so if you're taking the $3,600, you're taking the reduction, what if the surviving spouse dies? Well, then you've taken a reduction in your pension permanently to provide a benefit that's never going to be used. So, again, not to take you far down the rabbit hole, if you have a pension, please reach out. There's a lot of options there. There's a lot of things that folks don't understand that they need to take into consideration, and they are irrevocable decisions. Once you make a decision on your pension, it usually is locked into stone. Okay, so let's recap for a moment. We've talked about estimating how much annual income you're going to need in retirement. All right. We've also talked about how much income you can expect from employer pension plans, Social Security, then how to get that information. Obviously, going to the Social Security website and or collecting a statement on your pension. And if you compare these two, you're likely to find the gap. Now, that is unless you're lucky enough to have a very generous employee pension, you're going to have unmet retirement income needs that we're going to have to find a way to fund. And that's through your own personal savings and investments. Okay, so let's get into that. Personal savings, potential factors working against women. Again, we talked about some of these. When it comes to personal savings, we've already discussed women face some of these more unique challenges. Again, statistically, women earn less than men in similar jobs, and they're more likely to work part-time. Women also tend to spend fewer years in the workforce, primarily due to caregiving responsibilities, and then compounding the problems that women often start saving later and save less than men, which can reduce their chances of having enough income in retirement. Now, the combination of these factors means that you might not have enough savings in retirement unless you plan properly. Okay, we've already talked about that as planning. So these factors, though, explain why many women are at a disadvantage when it comes to saving for retirement, which makes it vital that they take steps to identify and address these projected shortfalls. So you have to do the planning today, guys. You have to do it. You have to understand where you are so we know, again, what the prescription is, the diagnosis, so we can write the prescription. Okay, personal savings, what you can do. Well, with all the challenges women are facing, what can you do? All right, so first off, let me state the obvious. The number one thing you can start doing today when you hang up this webinar, when you shut down this webinar, is if you don't give me a call, get on and start saving. Start saving now. Set a savings goal that you can work towards, keep track of your progress, and then monitor your investments and make changes as needed. You've got to get into it, okay? Now, again, a financial professional can help you. I'm more than willing to help in any way that I can. All right. Now, if your employer offers a retirement plan such as a 401k, 403b, start contributing as much as you can. If you're contributing the max amount to your employer retirement plan and you need additional options, that's great. So it's very rare that I'm meeting clients that have max funded their 401ks through work or their employer sponsored plan. But if you have, that's great. We've got some other options that we can talk about. Okay, some other options that we can talk about. If you're just getting into saving in your retirement plan, find out if you have a company match. If you have a company match, I encourage you to at least consider saving up to the match. What a company match is, the company may say, we're going to give you dollar for dollar up to the first 3% of contributions. So that means if you put a $100 bill on the table, they could put a $100 bill right on top of that. Okay, so you're making money by saving. So find out if your company has a matching program, and if do, consider strongly about getting involved. Okay, and then just become educated about investment vehicles. You don't have to be a financial advisor. You can hire one, but there's enough resources out there that you can have a general idea on how these work. Okay, and how to handle personal finance. Now, because many women will end up being solely responsible for their own financial well-being at some point in their lives, it's important that they have a sound understanding of the investment world and the confidence that they need to make appropriate investment decisions. So get educated. Again, if you talk to folks like myself, I'm more than willing to help you in any way, shape, or form. Get educated, grab a copy of the book or other books, and learn about, again, the different investment vehicles and just some general financial concepts. Okay. Let's talk a little bit more about these employer plans and IRAs. Probably the best way to accumulate funds for retirement really is to take advantage of these special tax-deferred retirement savings vehicles. All right, you've been offered them if you're an employer or an employee. Take advantage. A 401k plan and other employer-sponsored retirement plans, 457s, 403bs. If you know me or you work with me, you could be involved in some of those. Now, these are important savings tools because your contributions are come out on a pre-tax basis, which means it's reducing your current taxable income. Okay, and then these savings you're accumulating are tax deferred until withdrawn. All right, so at 59 and a half, you have access to these retirement accounts. When you pull the money out at that stage, that's when it'd be taxable to you. But what's happening is you're not being taxed up front and you're not being taxed on an annual basis, so you get this snowball effect. And then when you pull out in retirement, it'd be taxable for you. Okay, now having your contributions deducted directly from your paycheck can make it just much easier to sock away money versus having to write checks each month. Okay, so something else to consider. Again, we said contribute to traditional or Roth IRAs if you qualify. Roth IRAs, guys, we're going to have a whole, like I mentioned, I'm going to have a whole presentation on it. You may be able to contribute to a Roth account in your retirement plan, your 401k. Roth are after-tax contributions. Now, they don't provide you with an immediate tax savings, but they do allow you to make withdrawals free of federal income taxes under certain circumstances if done correctly. So there's a huge advantage of that as well. It makes sense to at least investigate and see if that makes sense for you. And if you're over age 50, you have the opportunity to make catch-up contributions. So that is a huge opportunity to talk to your tax advisor, your financial advisor about what that may mean to you and how you could make up those catch-up contributions so you can increase your savings. So again, from a savings standpoint, tax advantage accounts have a huge advantage. Consider that, consider the company match and the ease of it to your employer program, okay? So what can you do if you discover that after factoring your personal savings, the way that you're saving, okay? And that's what, again, we're talking about the planning process, that you've already calculated what you may get in the form of Social Security pensions, and you can see that, hey, I'm saving $100 a month over the next 20 years. Is that going to be enough or not? If it's not, what do you do with it? So again, that's why it's important to get the diagnosis today so you could write the prescription. We need to know because time is your ally, all right? So what are some of our options, all right? Well, one is we can spend less during retirement. So are there either expenses we could reduce in retirement, discretionary expenses that maybe we don't need, or are there ways to pay off debts now so they won't be there in retirement? Does it make sense to delay retirement? Okay. Could we work during retirement? Is this either full-time or part-time? Are there other potential retirement income sources? All right. And we'll talk about those briefly. Don't want to spend too much time on it. But again, as you might expect, delaying retirement offers certain advantages. So it's not what most folks want to do when we talk to them and they say, hey, look, it may make some sense to delay retirement. Not usually their favorite thing, but there's some advantages. Obviously, the longer you work, the longer you're able to continue to contribute to your retirement savings so you can accumulate more. Now, even if you just continue to work but you decide no longer to add to your retirement savings, delaying retirement postpones the date when you'll need to start withdrawing from your savings. So obviously, shorter distribution periods could significantly enhance the potential for your savings to last longer. All right. And as we discussed earlier, delaying your retirement may mean you can postpone claiming Social Security retirement benefits, which potentially can mean an increase in those benefits when you start taking payments. And then continued employment may also result in continued access to company-sponsored health insurance, which would reduce that cost, which many folks do. I see they go back, or they'll work part-time, or they'll work to help offset those healthcare costs. Okay. So of course, there could be some advantages if you plan on continuing to work in some capacity in retirement, even if it's part-time. All right. The obvious advantage is, again, you'll be earning money and relying less on your retirement savings, since we kind of discussed this. All right. That just leaves them savings. So for future growth, they'll continue to accumulate and grow. In addition, full or part-time work during retirement could potentially provide some access to affordable health care, which we've talked about. And if you work during retirement, you just want to make sure that you understand how the income you earn might affect your Social Security benefits, which we've talked about. Because again, while your earnings may increase your Social Security retirement benefits in future years, your current benefit could be reduced, okay? And this is where it gets complicated for folks. Another presentation we'll probably do just on Social Security. But for example, for the years before you reach your full retirement age, $1 in Social Security retirement benefits will generally be withheld for every $2 you earn over the annual earnings limits of about $18,240. Okay, so if you're earning more than that, they're gonna withhold a Social Security benefit from you. And these special rules apply in the years that prior to you reaching full retirement age. So again, if you're working and collecting Social Security, there could be some complications. So make sure that you talk with somebody about that. And it's also worth noting that a number of non-financial reasons may motivate individuals to work in retirement. For example, you may value social interaction. You just want to be around some other people, the sense of accomplishment. So there's nothing wrong with going back to work. There's some definitely pros and advantages to doing such, okay? This is an interesting one, and I think it's, we're going to have a quick discussion on it. I don't want to spend too much time on it, but it's something I'm seeing being a major player. Again, I just want you to think about other potential sources of retirement income that might be available to you during retirement. For example, you may have built up substantial home equity. Okay, it's possible that you could tap into that equity as a source of retirement income, either by selling the house and possibly downsizing, or by borrowing against the value of the home. And of course, this should be explored with extreme caution. There's reverse mortgages, a number of ways that I think people in the future are going to look to provide this retirement income gap that we talked about. How are they going to fund that gap? I'm thinking home equity may be one of the ways that folks are going to do that. Another possibility is borrowing against permanent life insurance. Many folks have whole life or universal life, or just what we call permanent life insurance that has cash value to it, and they may be tempted to use that cash value to help, again, offset that income gap that they have in retirement. So again, just things to consider, find another potential source of retirement income. So overall, let me recap. I appreciate you folks taking the time. Women are facing unique challenges, and the fact that longevity is a factor. They'll be living on their own for a period of time. Long-term care could play a role. Caregiving is obviously something that, again, I think is undervalued, and people aren't taking that into consideration from a financial planning and retirement planning standpoint, the impact that can have. So please take that into consideration. The objective of this presentation, one, is to encourage you, to motivate you. I want some action happening here from your end. So please consider doing a financial plan. If you're working with an advisor, sit down with them again, reevaluate it, make sure that you're on track. If you'd like a second opinion, again, please feel free to reach out. I'm Stephen Kirby again. My phone number is on the screen. If you'd like to send me an email, that's good as well. But again, I find if you just give me a call, we could have a quick conversation. If I can help you, I want to help you. So thank you again for joining our presentation. My last plug, grab your copy of You Are the Change. It's a beginner's guide to social responsible investing. It's on Amazon and Kindle. And again, all profits go to local charities. So thank you again for joining the presentation. Don't forget, don't just invest, invest to make an impact. Thank you so much. Have a great day.